Hello. A very interesting day in the stock market today. And we're going to be taking a look at a company that I haven't created a video for so far. It's called Coupa. And it looks like Thomas Bravo was actually able to snag the company for $8 billion, even though activists were actually pressuring the company, pressuring the board to hold off for an even higher price. Let's see the details. And of course, in this video, we're going to analyze the company and see whether it makes any sense and potentially any sense to be buying the company or not. See what happened and whether they are potentially even going private. Now, you will see when news surfaced last week that activist investors were taking the unusual step of pressuring Coupa Software to not sell for less than $95 a share. It got the attention pretty much of TechCrunch, is where I'm getting this article from. Because it's typically the opposite. I mean, you do expect investors to want these kinds of deals to go through because they make money effortlessly, pretty much. Now, they did sell the company, the board did, for $8 billion. And as you will see, Thoma Bravo is acquiring it. That works out to $81 a share, which still represents a 77% premium for shareholders. Now, if we take a look at our tool here, you will see that we are approaching this price, pretty much about $80 a share. And that's happening because the stock is actually up about 27% in the pre-market. From $62. That was pretty much its price last Friday. Let's go back. Now, you will see here that Coupa is a company that is making spend management software for large businesses. And it has been having a rough year in the stock market because of all these, software as a service companies have also been having trouble recently because a lot of these companies are mostly about growth and not so much about really making money. They are overspending, they are spending a ton, they are not really making a lot of money. Sometimes they are negative, most times I should say. And this is another one which is actually not making money, yet, people have been flocking around it, buying more and more. I guess that's just because their operations are doing well overall. But of course, we do want to be buying companies that are potentially cheap as well. We have talked about it in the past. We don't just want companies that are growing, but also we want to be paying a fair amount for these companies. Now, of course, again, we are looking at a company that is actually going to potentially go private here. As you'll see here, the letter believed published rumors that another private equity company, Vista Equity Partners, was in the hunt to buy it. But in the end, Thoma Bravo was the buyer along with a wholly owned subsidiary of the Abu Dhabi Investment Authority, also participating in the deal. And so it looks like Coupa is potentially heading for, privacy pretty much, so likely not going to be a public company anymore. Now, as you can understand, there is probably not much of a leeway in order to be making money here. Again, if it goes to if the sale is actually for $81, it doesn't really make a ton of sense to potentially buy this right now. Maybe if you want to scalp $1 or $2, potentially almost risk-free, because there's always some risk. If this collapses, there's always the risk of a deal collapsing at any point. But still, I want to examine and see whether this was a good buy here. Kind of take a little bit of a look at the financials, at least from what we're having over here. Now, you will see that the P ratio of the company is negative because the company has been losing money. Yet the nice thing about it is the fact that it's losing less money. Now, it's not necessarily the fact that it's losing less money, because this also has to do with the price of the stock, right, which has been going down. So this P ratio could be better because of the stock actually going down. Yet we do see, the revenue growing pretty much here, but the net income has been going down. So the profit of the company has actually been going down, and the free cash flow has been going up. So how is that the case? We'll examine that in more detail a little bit later. But you will see that the price to free cash flow is significantly better here, sitting at 30. Still not super cheap, but not super expensive either over here. Again, the price to free cash flow, I would say that this is happening more than likely because of stock-based compensation, but we're going to examine that. Now, outstanding shares have been going up. The company has been issuing shares, a lot of these from 2018. As you will see, about 43% extra. And it's a company that has significant liabilities compared to free cash flow, even though the free cash flow is easy to come by, it looks like, after the adjustment for probably stock-based compensation and the other items that we will examine. But the total equity here is also going up, again, because of these outstanding shares, because the company is not really making profit, right? And you will see that the company has little debt, which is nice to see over here, but their returns over here are pretty much negative because, again, they're not making money. Now, the financial statements in this situation are important because, I mean, in every situation they're important, but you can kind of see what actually led to this potential buyout. Now, $100 million pretty much in 2018 and 700 million in 2022. Remember, the deal was for 8 billion, which is about what is it like about 10 times the revenue, something of that sort. And in terms of the net income here, it's negative. And it's getting more and more negative, which is, of course, a thing that you don't like to see. With the EBITDA also being in negative territory and, again, getting more and more negative here. So more expenses, it looks like, over here for the company. Yeah, you can kind of see that here. The total operating costs and expenses, for example, it's getting worse here. And the operating income is getting worse as well. Okay. And what about the balance sheet? In terms of the balance sheet, you will see what you would expect to see. Things that we have been talking about in previous videos pretty much. The fact that the company has been issuing tons of shares and getting additional paid-in capital over here from investors who are buying the stock. You can kind of see the entry here. And the assets of the company, that I should say the total equity of the company, has been growing because of these. It's these basically that make the difference. The total liabilities are sitting at $2.2 billion. That is the last fiscal year. In terms of its cash flow statement, again, negative net income here, and let's examine the adjustments that I talked about earlier. So you will see that it is stock-based compensation and depreciation amortization. This one doesn't have an entry here, but it's still part of the adjustments. Just the numbers not here, but still, actually, the positive numbers here have a lot to do with depreciation, amortization, stock-based compensation. Maybe it wasn't even an item over here. You can do the addition and see actually that it doesn't even seem to be an item here. But overall, the company has been paying a ton in stock-based compensation, at least in the previous years. And also some depreciation, amortization. This is what makes it positive, the operating cash flow over here. Yet again, the net income was negative, and it's, the adjustments, the non-cash expenses, basically, that make it a positive number. But remember, this number was derived from a negative number, so that's always a bad thing to see. We want both our net income and our free cash flow to be positive. It's important. That's very, very important. And in terms of investing activities, very little things going on here. It was mostly last year where the company actually acquired something. And financing activities, getting some extra debt. You have to, as a company of this sort, because you're not really making money, right? So at some point, you have to get some extra debt. There's no way around it. You either issue shares or you get debt, or both. And this is what's happening with this company, pretty much both, or has been happening. And the free cash flow, again, after the adjustments, 15 million, 30, 56, 66, and 154. At least it's a little bit better. But again, remember, it's coming from negative territory here, negative net income. If we take a look at our stock evaluation tool, this one doesn't have a dividend, so we're going to be using the discounted cash flow model and see what we get out of this one. Let me click here. Okay, so you will see that the revenue growth of the company has been sitting at around 30%, 40%. You can kind of see the exact numbers here. It's mostly 30 and 40%. We're going to go in between and lower, of course. So 10, 20, and 30, let's just say. 30 is pretty high for the next 5 years. I don't know that this will continue, but 20 is a possibility, I think. In terms of the margins, though, this is where the problem lies because, again, the company is negative. It's not making money. Now, again, if a company doesn't make money, it makes no sense to be buying this company. The thing is, if they start, making just a little bit of money, then their net income margin is going to be marginally positive, something like 1%, 3%, and 5%. If they're making just a little bit, right? And then they keep growing their operations, they make more and more and more. But if they don't make money in the next 5 years, what's the value of this company to us? Probably it doesn't make a lot of sense to be buying this one, right? Because otherwise we are basically buying something that loses money. There's not much point to that. And we are taking a leap of faith of potentially the company becoming a behemoth. And a lot of companies just fail. You just don't know whether this is going to happen with this company or another company. What you see here is just that the fact that the net income is going down. And so you don't necessarily know that this is going to be a winner. However, we're going to be using 1%, 3%, and 5% just to see what is the current price to pay if we decide that this company could reach profitability soon. And in terms of the free cash flow margins, again, we cannot use these numbers because they are coming from negative net income, so they don't make much sense. And so we're going to use something that is typical, 80, 90, and 100%, and an annual return of 13% is what I'm going to be going for. And I hit calculate, and you will see that, of course, there's going to be massive differences between these numbers because of the revenue growth, right? This massively affects it. And of course, the net income margins are significantly different here. 1% to 5% is a pretty large difference, especially with a 10% and a 30% revenue growth. So the low one is at about like almost $2 here. The medium is sitting at 7.8 and the high at 21. The current price is actually about 80, right? Remember, 81. So it wouldn't make a lot of sense. Like, again, this is the current price, but it was bought. It's going to be bought at $8 billion, which is the price. The share price would be $81 for this buyout. When you see the actual amount that is being paid, right? Like, remember here, it was $8 billion. So we talked about it. It's coming at about $81 a share. And as you can understand, this is expensive. This is very, very expensive for this kind of company and what they are doing. And so, I don't know whether they have some specific plans for the company, what they want to be doing. They are taking it private. So investors who were owning the company, I think they should be happy instead of actually wanting to wait potentially for an even higher gain here. That's a pretty interesting premium here, very nice premium. And again, it's a company that's not making money. So yeah, it may end up being a fantastic company, who knows, through the years. But as it is right now, I would definitely be selling this if I were a public stockholder. And congrats to the people that are gonna be getting some money. But thanks for watching the video, guys. Remember to leave a like, subscribe, and of course, become a patron if you want to get access to this tool and everything that I have used so far. Stay tuned, more videos to come your way today, and I'll see you soon. Bye-bye.